Let's bring Doug Flynn in on the business news, certified financial planner and co-founder of Flynn Capital Management. And Doug, we're speaking as Xi Jinping and Joe Biden are also speaking out there in San Francisco. You know, one of, I think, the questions about China coming into this big summit between the two leaders is how is their economy doing? Particularly, you know, their growth numbers that came out today I thought were okay, right? But particularly their property sector. You look at the property sector in China, and it's been a big concern as it continues to fall. So, does that make it more likely that Xi Jinping is willing to give in, that Joe Biden and the United States has some leverage over China for a change? What do you think?
Well, I think it does. I think that, the external demand from outside the country of China, that is weak, and they're trying to drum that up. They're doing some stimulus to just moderate effect over there in China. And the problem they have really is if they do more stimulus or lower their interest rates, money is fluid. And if you're an investor over there or anybody with money, and you could go here at higher rates or there at lower rates, where are you going to go? So then you have a massive outflow of capital. So they're trying to balance enough stimulus to keep their economy going, because it is showing a lot of sign of weakness, primarily in the housing area, especially. And so they're trying to fix all that, and drumming up business from the U.S. and other places is one way to do that. But whether or not it's enough, I don't know. Right now, their short-term numbers are good, and the longer-term numbers aren't looking so great for next year right now.
Yeah, because as you know, the relationship has not been great between the two countries, and that's a big deal for Wall Street, for American business. And I know just about everybody, Republican, Democrat, no matter who you are, has been negative on China for the last number of years, and we understand why. But is any of that starting to change, or how would you look at China, from an investment perspective?
I still have a problem with them being considered an emerging market. They're still considered an emerging market in the investing world, and they're the second largest economy in the world. I think their demographics are absolutely terrible. If you do any Googling of China demographics versus India versus even the United States for that matter, they've got a really long-term problem. So I am not really very bullish on China long-term. And forget the whole communism thing. I mean, we can get into that if you like. But the issue is, I would much rather go to freer economies that have a forward trajectory of positive population growth in other places. There are plenty of places in the world to invest that more align with perhaps the way we do things here.
Yeah, I'm happy to forget about the whole communism thing, Doug. That's fine. Yes, we can forget about that for now, or put it aside. Okay, so we have the numbers here, our telestrator, on the Chinese economy that I was talking about for property, first of all. Then I want to shift over and talk. There's the property numbers. So this is what we're, when Doug and I are talking about a drop in property, this is what they're dealing with over in China. This sales down 7.8%, investment down 9.3%. Let me flip it over to our economy and our inflation, wholesale inflation. That's what the producer price index, down 0.5% September to October. So I think you and I talked yesterday about inflation kind of cooling off. That was consumer prices. This is the wholesale level. So again, this is the first time in quite a while we're getting, things are improving, but it's the larger sign, we see this in retail, is that it's because the economy's kind of cooling off. So, good news, bad news. How do you read it?
I think it's actually good news from this perspective. The retail sales are falling. The producer price index had the biggest decline in, I think, 3.5 years. So what that does is it just shows signs that the index and inflation is beginning to normalize and consumer spending is coming down. And what that means is that then the Fed can stop raising rates officially at some point if that continues. And that's a good sign to keep us out of a recession. Because right now it's not falling hard enough to really have us fearful that we're going to go into a recession to any large degree at all. And that's what this is showing. It's kind of walking the line of saying, forget each individual number. I mean, if you're a viewer, you're saying CPI and PPI and this and that. One is up, one is down. What you're looking for is the trends. And even though something might pop up, the overall trend is very slowly going down. And that's a good trend to have. And so if they can land it perfectly, then rates are already high. We've got an opportunity to then lower them. And right now the market's baking in that by next May, they will lower rates. Now, whether or not that comes to pass, we will see, but that's what it's looking at right now.
Yeah, that's why we've been on this great run for anybody that's in the stock market, at least. So we'll take it while we have it.
I have something for you, Connell. So we're almost at 35,000. I have this hat right here, and I'm ready. So I'll bring it out next time when we hit 40,000. Should we hit that? So
back in my
that's what we're
business
looking
news
for.
days, I had the 10,000 hat, but that's a collector's item now, collecting dust somewhere. All right, 40,000, Doug. We'll see. Doug Flynn on the economy and the markets, as always. Thank you, sir.